All right, Macro Unit 7, Screencast 5. I forgot to change my shirt. Hold on a second. And the very last screencast ever of AP Economics. I'm excited. Today we're going to talk about exchange rates and monetary and fiscal policy interactions. We're going to bridge what I did in the last screencast to how that affects our domestic economy. This is going to get confusing, which is kind of nice because I think confusing is a good way to go out. Alright, so a little review. Last time we saw that various things can affect exchange rates, and I've listed for you here what those things were. Change in tastes and preferences, change in incomes, interest rates, price levels, speculation. And we also saw a couple of things in the last screencast that we need to remember. You can recall that these factors affect exchange rates, and therefore they're going to make the US dollar appreciate or depreciate. And more importantly, we've also seen that when the dollar changes in value, net exports start to change as well. Appreciation causes net exports to fall, and depreciation causes net exports to rise. Now, it gets a little bit more confusing because when net exports change, aggregate demand changes. And going back to what we know about aggregate demand, when aggregate demand changes, that has an effect on our economy. It starts to affect things like price level, it starts to affect things like GDP, and if GDP is changing, Americans' incomes are changing too. Remember, there's two approaches to GDP, the expenditures approach and the income approach. So if GDP goes up, it means we're making more stuff, more people have jobs, we're making more money, our incomes change, and etc. So it starts to get a little circular and it starts to get a little confusing. And what you'll notice is that everything kind of starts to affect everything else. Now, what we saw back with monetary and fiscal policy is that monetary and fiscal policy can directly affect these some of the factors that in turn affect exchange rates. Monetary and fiscal policy causes aggregate demand to move, which changes price levels, changes GDP and incomes. We've seen that monetary and fiscal policy might have an effect on interest rates, which is another thing that affects currency exchange values. So monetary and fiscal policy can affect exchange rates, which affects net exports, which can affect aggregate demand, which can affect exchange rates, and on it goes. We start to get into like a chicken and the egg problem, where one thing's causing another, and we can kind of lose track of what the initial cause was. Alright, so I want to take you through an example of how complicated this can be and kind of give you a sense of how to think these things through. Let's forget exchange rates for a bit, and let's just solely focus on our country. Let's say the Federal Reserve decides to follow an expansionary monetary policy. Maybe we're in a recession. Now, going back to what you know about expansionary monetary policy, we could think about what that might do to things like interest rates, what it might do to price level, and what it might do to GDP and therefore incomes in our country. Going back to that cause and effect chain of how monetary policy works, it might look something like this. The graph on the upper left is that money market graph. On the upper right, we have the investment demand curve. On the bottom, we have our aggregate demand, aggregate supply graph. We know that an easy money policy would shift the supply of money to the right, which would make interest rates go down. Shifting over to the graph on the right, when interest rates go down, the quantity of investment, big I, goes up. Shifting to the bottom graph, when big I goes up, when investment goes up, that increases aggregate demand, and that has an effect on price levels and GDP. So an easy money policy is going to make interest rates fall, it's going to make price levels rise, it's going to make GDP and therefore incomes rise as well. So in this example, we can make predictions about those things. But wait, go back to your notes about exchange rates now. What's going to happen to the value of the US dollar if interest rates in fact fall? If prices fall relative to other countries in this, what's going to happen to the value of the US dollar if incomes rise? Might be a good time to pause the video, go back to the last screencast, and again think through what that would do to the value of the US dollar. All of those things are going to increase the supply of dollars in those foreign exchange markets as US citizens try to get their hands on foreign currencies like euros in order to buy foreign goods. And if you don't understand that, again, you need to go back to the last screencast. So as a result of all these things, the US dollar we can predict would start to go down in value. The US dollar would depreciate. But wait again. Because if you go back to your notes about exchange rates, that depreciating US dollar is going to have an effect on net exports. Depreciating US dollar is going to make net exports rise. If net exports rise in turn, that's still, again, going to have an effect on our economy. If net exports increase, we can think about what that's going to do to aggregate demand, what that change in aggregate demand is going to do to things like GDP and price levels, and so on. So you can see that it's kind of circular and it keeps on going. Around and it goes. Everything kind of affects everything else. What's going on with exchange rates has an effect on the US economy, and what goes on in the US economy has an effect on exchange rates. So the way to handle these kind of questions is to kind of take it one step at a time. And what I'm going to do online is give you a practice assignment along with the answers so you can kind of see how these problems would be thought through. On the AP exam, focus on the specific question that they're asking and remember a few things. And if you keep these few things in mind, it should go a lot easier. First off, expansionary monetary policy lowers interest rates. It pushes aggregate demand to the right, which makes GDP and income increase and price levels increase as well. Remember also that expansionary fiscal policy has an effect on interest rates too. It makes interest rates rise due to that thing we call the crowding out effect. It also pushes aggregate demand to the right, raising GDP and price levels. Remember that incomes, interest rates, and price levels can affect currency values, and again, it's important to know how it is that they affect currency values. And finally, with a very small bullet point for some reason, currency values in turn affect net exports. All right, it's been a journey. I appreciate you sticking it through. Now go kick ass on the AP exam.
Ladies and gentlemen, the unthinkable has happened. Some sick, twisted individual has stolen every teacher's edition in this school.
What do we do? Declare a snow day!
Does anyone know the multiplication table?
Please, don't panic. They can smell fear.